Oh man, so Peloton is down 9% in pre-market after being down as badly as 15% after the close when they reported their Q2, but their fiscal year Q4 earnings. And this is what their earnings were. So they produced a net loss of 312 million, which is $1.05 per share. That is worse than the 44 cents expected by Wall Street. Revenue, they actually beat on revenue. So they were 937 million versus 928 million expected, and revenue grew 54% from this time last year. So why is it tanking? So obviously the revenue, the net loss was wider than expected. It was double what was expected by Wall Street. So that's a big red flag for them. But there's a few other things which were not great for PTON in this earnings call. And let's take some time to go through these. So subscription revenue was actually up 132% to 281 million, which we'll come on to because that's quite an interesting point. But they gave weaker guidance. They expect Q3, which is their first quarter fiscal year, to be around 800 million in sales versus the 1.01 billion that Wall Street was expecting. So that's a big revision to guidance, and Wall Street's not taking to that lightly. But that's not even it. That wasn't the worst thing, because the worst thing is they plan to slash their bike price for their main volume-based the high volume item. They want to drop that by 20%. Okay, so not their expensive bike plus, but their normal bike range. They're slashing that from $1,895 to $1,495. And this is already after it was slashed $350 this time last year. When the bike plus was first released, they already slashed the bike, and now they're bringing it down further to $1,495. And Wall Street were not expecting this. And they think this is a sign that Peloton are now struggling to acquire new customers, and they need to spend more and widen that loss in order to gather new customers. So Wall Street's kind of concerned that they're having to slash the prices in order to build market share. And this also, it does fundamentally go against how Peloton initially came into the market. Their branding was around being the exclusive, being the best. Those that want to spend $3,000 on a bike, come get one from Peloton. But now they're trying to lower the prices down to a more mass market price, which is interesting, but Wall Street has not taken nicely to it. Now, looking at some of their other KPIs, they have 2.33 million connected fitness subscribers. That's 114% actually increase from a year earlier, which is interesting because that was the peak of COVID. I mean, August last year, everybody was at home. So for them to have 114% increase in their connected fitness subscribers is no mean feat. And then digital subscriptions were up 176%. So the digital subscription is where you don't need the equipment and you can sign up. And the connected fitness subscribers are the ones where you buy the bike and then you buy a subscription as well. So you can do your training courses on there. So two interesting metrics there, both growing quite strongly, really. And then average net monthly connected fitness churn. So these are the percentage of people churning off of their connected fitness plan, ticked higher. So it was the prior quarter is 0.31. It was 0.52 a year earlier in the peak of COVID, and now it's 0.73. So could this be the reason that Peloton is tanking? I actually sold my position in Peloton a few months back. I did think they would struggle and get these kind of earnings, and Wall Street will over panic. But I still think fundamentally it's a strong company. I'm a bit concerned about the price change. Does that mean their cost of acquiring customers really spiking and they're struggling? I mean, they've already got the brand awareness, so there's almost a plateau and a diminishing returns from a marketing perspective and brand awareness perspective. Is that why they're now slashing the price to try to do what Tesla did and go for a Model 3 and a Model Y to reach a wider audience? That's a bit of a concern. Why did they have to slash that price? The churn is less of a concern. I mean, the fact that it's ticked up to 0.73 versus 0.52, it's kind of expected. I mean, you would have had a bunch of customers in COVID, and all investors would have known this. You would have had a bunch of non-loyal Peloton users, a kind of demographic that Peloton wasn't really trying to go after prior COVID, which just came on during the COVID period, and naturally they're going to roll off. And even if they could retain some of those, is a fantastic feat, but they're almost like free users, right? They were unplanned free users. So it doesn't affect the long-term really vision of Peloton. But slashing of the bike price is a bit of a concern. So Peloton are actually saying that the price cuts will make the bike more accessible. They have plans to open a $400 million US factory to be up and running by 2023. These all things we'll have to wait and see what kind of impact does this have. We know that they would have suffered from supply chain shortages like many manufacturing companies have. But then the other thing they mentioned in their letter was interesting. They said they found a material weakness in internal inventory controls, and that doesn't sound good at all. So basically, the way they're doing their accounting in terms of their inventory, they found a material weakness, which means something quite serious. They're saying that's not going to reflect their previous earnings. They're not going to rerun or make any amendments to their previous earnings, but they thought they'd mention it there. Maybe we'll get some more information about that on the earnings call. And then a statement from Chief Executive, one of the paragraphs he said is, the past year represented an inflection point for the connected fitness industry, with significant increases in awareness and demand following the onset of COVID-19 pandemic. So he's saying this is an inflection point. Before COVID, we knew what our audience were. Some people who were early adopters of Peloton knew who we were, but now everybody knows because they're at home. They were all searching. They were all looking for the best fitness bikes and treadmills, and they were looking for online PTs. And they're saying this is really inflection point. But Peloton have to go and prove that. They have to go and prove that all these customers that have come on, they're not just going to churn off. So that uptick in churn is expected, but you don't want to see it keep expanding to a point that you've just dissipated all the gains you've had from the COVID year. And that's what investors are going to want to look at over these next few quarters. Now, Peloton have said they're not going to be profitable until at least 2023. We know they took a bit of a hammering in this last quarter because of the safety issues around the tread. We made a video on that. They recalled the tread, which is now going to come back into available for sale in the next week or so, which should really boost up their quarterly earnings. But I think it's going to take time for it to get back into the system, which is why Peloton might be sandbagging their sales for Q3 a little bit with the 800 million projection versus what Wall Street is expecting is $1 billion. But I think that's a sensible thing to do. Take the hit now whilst all your other metrics are kind of indicating weakness. You're going to get hit on your share price anyway because of your net loss. So there's no harm in you kind of changing guidance slightly and just making sure that your next earnings, you're giving yourself a chance of beating that effectively. So there you go, guys. An update on Peloton. They have a miss on their earnings. They beat on revenues. Subscription revenues going up. Churn ticked up slightly. The bike prices has been slashed by 20%, which is interesting. Does this reflect a deeper issue around cost of acquiring a customer? The tread has resolved its safety issues, and they're going to be releasing the tread in a week or so back into production. And they're building a 400 million factory in Ohio in the US. So there you go. We'll keep an eye on Peloton. Like I said, my position is actually 0 in Peloton at this point, but if it keeps dipping, fundamentally, I don't think there's a massive issue with this company. We just need to see over the next few quarters, does this churn go one way, or can it start to plateau back to their 0.5% churn level, which indicates that they're able to keep some of these pandemic era customers on their books and upsell them and cross-sell them. That's what's important here, guys. All right, we'll see you in the next one.